Donald Trump has just started his presidency, right? So we can expect some of this volatility to last for a while.
Even if I have a small amount of capital, I can actually start because that's actually the best way for me to learn.
The first thing they always say is that when they open an account and go into a platform, it looks so intimidating.
Right.
So back to what I was saying. Could be us.
Hi everyone, so welcome back to the Beansprout Podcast. We're very excited to be doing our second episode. Big thank you to everyone who tuned into the first one. As you know, we started this podcast project really quite spontaneously in response to some of the more exciting market movements that we've seen this year. And we thought it would be a nice way to kind of follow up to really just check in on what we have been doing and investors looking at our own portfolios and seeing how we can manage the uncertainty that's been happening these past few weeks. So before we just sort of like jump into what we want to talk about today, maybe Gerald, you could just give us kind of a quick rundown of what's been happening since the tariff announcements were made and things like that.
So there's been a lot that happened. First and foremost, we had the general elections in Singapore.
That's right.
But I think from a finance and global macro perspective, we have actually seen a lot of the panic that came through right after the tariff announcements actually easing. I think that is a result of the fact that Donald Trump has shared there's been progress made in various trade talks. Likewise, different US government officials have also expressed optimism around the trade talks. So as a result, if I were to look at the S&P 500 today, it is actually not too far away from its recent high. If I were to look at the Singapore market, the STI is now back to above 3,800 points. It's actually within 5% of its all-time high. So a lot of the panic and uncertainty has actually eased, and investors are actually more optimistic that a lot of the trade concerns are actually overdone. So for those who actually held on to their stocks, thankfully they did not sell. But I think that also then raises the question what investors should do. The other facet that is worth highlighting is that initially we talked about the spike in bond yields after the tariff were announced. This was a result of the suspicion that many investors were actually selling US government bonds. Since then, uncertainty has also eased. So we have actually seen bond yields coming down once again as investors look for bond assets to park their cash. So if I were to look at the latest 6-month Singapore T-bill auction, the yield was just at 2.3%. Just 1 month ago, it was still at 2.5%, which is close to the CPF OA interest rate.
Right.
So bond yields have come down further, which is why we get a lot of questions around where we should park our cash in this environment.
Yeah, which kind of brings us to, I guess, the topic for discussion today, right? So what are we hoping to get into today, Nicole?
So given the macroeconomic uncertainty and the fact that bond yields have come down, we get a lot of questions, like Gerald said, on where should we be parking our cash? How do we invest in this current environment? So we're going to go through different types of asset classes that investors can consider when it comes to what they can do in the current environment. So like Gerald mentioned earlier, T-bill yields have been coming down, and for me personally, I've been looking at other areas on where I can park my cash savings. And one of the good things about Beansprout is we write a lot of content on all the areas that we can actually park our cash for higher savings. So I've been considering a few options. I'm going to run through it really quickly. It all depends on what your considerations are. So like for me, for instance, my cash savings are cash that I might be using for emergency funds. So liquidity is pretty important. Or it could be a separate cash pile that I might be needing to use in the next 6 months to 1 year for like short-term goals. So given those two considerations, then I need to think about, okay, for emergency savings, what are some areas that I can put it in? So one option that I was looking at is high yield savings account. High yield savings account basically are your savings accounts, but it provides better interest rates for you for putting your money in there. But you have to actually hit some criterias, like you have to have a certain minimum amount, or you have to be spending on the bank's credit cards, or you might have to save a certain amount every month to maintain the monthly average balance, right? So some of the ones that I found at the moment, they kind of range from the 2.58%, which is with GXS Bank. So that's like a really no frills. You don't have to think so much about jumping through hoops. You can just sign up and park your money there. 3.3% with OCBC and UOB, depending on the total amount of savings that you have in there. So that's one option. The second option is, like I said earlier, I could have savings that I might not need just yet, and it's not in my emergency pile. So I need it maybe like in 12 months' time. I can consider putting my money in fixed deposits. Fixed deposits, there are the SGD denominated fixed deposits. Right now, I think the best 6 months FD, so if you want to compare that to the 6 months T-bill, is coming in at about 2.4%. The other option is USD fixed deposits as well, which gives a much higher yield. But I think the consideration for that, recently in the news, I heard that the Singapore dollar is strengthening against the US dollar. So if, let's say, I'm parking my funds in USD, that could be a case where even though I'm getting the higher yield, but because the US dollar is dropping against the Singapore dollar, then the returns that I might get from that is actually lower. For that one, I'm trying to think, okay, am I going to be using USD for maybe if I'm traveling overseas to other places, would I actually use that pile of cash in USDs? Probably not at the current time being. So then for me, I think it makes more sense to have it in Sing dollars. And then one more option that has been talked about is the Singapore Savings Bonds. So Singapore Savings Bond is government backed by MAS, and it is a savings bond that has a tenure of about 10 years. This gives you the opportunity to lock in interest rates now before it might drop a little bit further. So currently the SSB for this month is at 2.56%. So these are some of the, I guess, the more simple and easily accessible instruments that are relatively risk-free, in my opinion. Like for the savings account and the FDs, is backed by it's SDIC guaranteed, right? So that means that the banks aren't going to basically take your money and run away with it. And SSB is backed by the Singapore government. But there are other options as well if you are someone that is okay taking a little bit of risk. And I think one of them would be cash management accounts. And Gerald, you were talking about cash management accounts earlier. Maybe you want to explain it to our readers as well.
Cash management accounts are investment products. Some of the options that you shared earlier were savings accounts, they're SDIC insured, but when it comes to an investment product, they would then not be SDIC insured. So I think that is first and foremost what we need to understand. And because they are investment products, they are also not capital guaranteed. So there is actually a risk of losing your capital, whether is it a high risk or a low risk investment. So what these money market funds do is they would take our invested money. The manager would then take this money to then source for the best deposits to actually put this money into. And by actively doing that, they aim to be able to generate a return that is above the savings account rate. The good thing about these cash management accounts, particularly those that hold the money market funds, is that they provide liquidity. So unlike the fixed deposit rates where you have to lock in your money for 3 months, 6 months, 12 months, the ability to withdraw your money from this money market funds is there. Just one point to note is that it is not an immediate withdrawal. So because it is an investment into a fund, there's usually a redemption period that might take 1 or 2 days. So that's something that I will look up on to understand how long does it take to be able to withdraw my money.
Let's say if I'm someone who is completely new to all of this. So I think as I shared in the previous episode, my approach to investing is really, I put most of my money in ETFs and then I have some money in my bank account, right, that I use for day-to-day expenses. How do I know, how do I begin to navigate some of these different asset classes? And what should I be thinking about if, I do want to, park my money in places where I can get, I guess, what would be a decent return, but also have access to that cash when I need it.
I think one thing to consider is what I mentioned earlier is how soon you need the cash.
Right.
So,
and how do I define soon?
Soon would be like, let's say if tomorrow you will get into a car accident, for instance, and you need the money, or like, you know, you had an emergency, your laptop broke and you need the cash to pay for it. If it's locked up in your FD account, then you can withdraw it from your FD account. There's no issue doing that. It's just that you won't earn the interest. Yeah, so if the FD account penalizes you for withdrawing it early. That's why having two separate piles of cash, one for your emergencies and then the other one for your short-term savings. So it's short-term savings. What are those, right? It can be things like, you're going to do renovation on your BTO, which is going to be happening in probably the next 6 months to 1 year. Or if you're putting money into a wedding fund, which is going to be something that you're going to access that cash. So, but not so soon. Right? I'm assuming it's not going to be so soon. Putting it into FD, for instance, might make more sense.
Because I think sometimes we hear from younger investors that there is some curiosity about some of these things. They don't really know where to start or how to think about it. Like, how do I really know what am I going to need, right? So there is also kind of that wanting to have that flexibility as well.
I think one good rule of thumb to practice is that if you have like goals, right? So we talked about goals-based investing in the previous episode. So like, for instance, if you have a certain amount of money that you need to set aside for your renovation, how much is that? Right. So
and I guess when do you actually need that money?
Exactly correct. So all like deposits that you have to pay down to like the contractors, to your ID and things like that, it may not happen at the same time. So I think having a timeline and a plan for that, you know, putting it into an Excel spreadsheet, with the dates and things like that, then from there you can already identify, okay, this money I need it, whether it's next month or 1 year down the line.
Does it have to be an Excel spreadsheet?
I mean, that's something I would do, but you can do other things also. You can just write it down on a piece of paper, but you know, I'm more of an Excel geek lah. So.
I think the other rule of thumb is to have 3 to 6 months of emergency cash. So even without any goals towards buying a property or say saving up for a marriage, it is good to have this emergency cash because the job market is more uncertain at this point in time. We just want to have sufficient savings to be able to last us through any unexpected developments in our life. Then the question is where to park this 3 to 6 months of emergency cash that you want to be able to withdraw at short notice. So a lot of the options that Nicole shared earlier can be considered. The only question is whether you want to be jumping through some of these hoops to be able to earn the higher interest rates.
I think for most people, they don't realize that some of these hoops are actually quite easy to hit. So if it's a case of making sure that you have a minimum balance in the account or minimum monthly average balance, plus salary credit. So if you are employed full-time, technically you already have salary credit into your account. And spending on a credit card, you are spending minimum, like I think it's only $500 a month on a credit card, and if you can credit like 1,600 minimum salary, then you already hit the criteria to basically get the higher interest on the high yield savings account.
Right. Okay. So we've talked about some of these, cash alternatives. For investors who maybe, in this current market environment are looking to invest in other asset classes, like what are some things they should be thinking about?
Given that the ability to earn a good interest rate with relatively low risk through the T-bills is now no longer such a viable option, one of the questions that we've been getting is, if I want to generate consistent income, how do I continue to do that? I think that's where a lot of the discussion around other income assets have come in. So some of the more popular ones would include bond ETFs as well as bond funds. It would include Singapore REITs. It would include your dividend yielding stocks. So we have reasoned quite a lot about these different asset classes. I think first and foremost, if I were to look at bond ETFs as well as bond mutual funds, bonds are effectively seen to be lower risk compared to stocks. That is one starting point for investors who want to be still earning a good income, but not taking on as much risk compared to buying into stocks. If I were to look at bond ETFs and bond funds, I think a lot of investors often start by looking at the headline yield, whether it generates 6%, 5%, 4%, as a way to consider whether to invest in this bond ETF or bond mutual fund. But what we have often shared is that there are also two key things to be looking out for. The first one is really the underlying exposure of the bond ETF or bond mutual funds. So A bond ETF can actually be something that is relatively low risk if a lot of the funds are deployed towards, say, buying the Singapore government bonds, such as the ABF Singapore Bond ETF. So that effectively would be quite similar to us going out to buy the Singapore T-bills ourselves, just that in this case, the fund manager would be the one helping us to manage. They would be the ones redeploying the capital when it has actually matured, and we don't have to be building a diversified portfolio of Singapore bond T-bills by ourselves. But at the same time, there are also bond mutual funds that can be higher risk because they might actually invest in, say, US corporate bonds. They might invest in the Asia high yield bonds, which have a higher risk because there's a higher chance that some of these borrowers might default compared to, say, the Singapore government. So I think that is the first thing that I'll keep a lookout for to understand the exposure. The next thing to keep a lookout for is really what is the average maturity of these bonds. So if I buy into a bond, typically you would see that this bond might mature over a period of time, which is when the borrower would then have to pay back the amount that's been borrowed. So I've seen, say, the yield to maturity or the average duration of this bond ETF or bond mutual funds being potentially, say, 5 years or 1 year, which tells you what's the average time in which the portfolio of bonds actually mature. One point to take note is that the ones with a longer maturity typically have larger movements in their prices compared to the ones with shorter maturity. So once again, if I want to be taking on lower risk, then maybe I'll consider one which doesn't have such a long maturity, and maybe something that can have the bond portfolio maturing within, say, 1 to 2 years, might actually present lower risk compared to maybe one that, with the same quality of bonds in the portfolio, matures in, say, 5 to 6 years.
The good thing about bond funds is that you don't actually need a lot of capital to get started.
For bond ETFs, you can actually just buy one unit on the SGX. So effectively, you can invest in some of these bond ETFs with a few $100s. Of course, you would then have to consider your trading costs and your brokerage fees. But given that the brokerage fees have come down in recent years, they might be less of a consideration compared to being able to invest in some of these bond ETFs in smaller bite-sized units. For the bond mutual funds, it really depends on what platform you're buying it through. So some platforms allow you to buy some of these mutual funds in smaller denomination. Some actually still require you to buy them in, say, minimum $1,000. So once again, we will have to check what are the different bond mutual funds that are offered on the different platforms, what's the underlying bond mutual fund that you're buying into, and from there understand what is the best platform through which we can buy this funds.
So you also mentioned earlier, so besides bond funds, there's REITs as well, right? So that's completely different from bonds, in that REITs are investment trusts that invest into property.
That's right. So I think REITs are a very popular asset class among Singapore investors because they have been able to provide dividend payouts in the past. So effectively, for those who are looking at income, it has become a fairly popular option. The other thing that has interested a lot of investors in REITs is because, like you mentioned, they invest in real estate assets. So a lot of these real estate assets are in assets that we might be familiar with: shopping mall, it can be an office building, it can be a data center asset. And I think for some investors who see and touch these retail malls as an example, they might feel more comfortable buying into this REIT because they know what they are buying into. They feel better track the performance of the shopping mall and hence gain confidence towards investing in this REIT. So a lot of the shopping malls that we are familiar with, Somerset 313, Iron Orchard, Plaza Singapura, they would actually all be owned by the REITs. And it is actually one of the ways that we can gain exposure towards this shopping malls by owning a share of the
Then I should invest in REITs because I go to the shopping malls all the time.
I think what has also made them popular is because of the REIT regulations in Singapore. The REIT manager is mandated to pay out 90% of their net property income to unit holders. So as a result, if they're able to earn a good net property income from their leases, they will then have to pay out this rental income to you as a unit holder.
Yeah. So I noticed that you said that in the past, it's always paid out consistent dividends. Looking ahead, do you have any thoughts on whether this is something we can continue to expect?
So we actually recently did a webinar solely on Singapore REITs. So do catch that episode where I spent 1 hour just explaining the outlook of the Singapore REITs.
Okay, we should link it in the comments.
Yeah, we will probably do that.
I think in this environment, we have seen actually the REITs not doing as well over the past 3 years. There are two key factors behind it. So first and foremost, the interest rates have actually been going up over the past few years. And the REITs actually borrow to be able to purchase the real estate assets. So just like we'll borrow to be able to buy our property, likewise the REITs will also be borrowing to be able to buy the shopping mall or the office building. So with the higher interest rate environment, they have had to incur higher finance costs, and as a result, their distributions have been impacted. Secondly, the fundamentals of the REITs have also been mixed. So for example, after the COVID, we saw some of the office REITs impacted by the work from home trend. So maybe the office rents were not as strong as in the past. Then some of the REITs that have got overseas assets, because of the strength of the Sing dollar relative to say the Japanese yen, the Indonesian rupiah, the Chinese yen, their distributions have also been impacted as a result of that. So I think because of some of these factors, we need to be paying more attention to what REITs we actually buy into, or if we don't actually have the confidence to be able to select a REIT by ourselves, then once again the key is to diversify, maybe through a REIT ETF that offer broad-based exposure towards a portfolio of REITs.
Right. Okay, so other than REITs, we often get questions also about Singapore stocks, right? And whether they're still a strong income play. What do you think?
If I were to look at the REITs, the exposure is simply towards property. So I think that is where some investors are thinking that it might not be as diversified in terms of being able to help them build up an income portfolio compared to being able to get exposure from many different areas, whether is it in our banking system, or whether is it through, say, some of the supermarkets or other companies that are able to earn a consistent income and being able to pay out these dividends to shareholders. So I think that is a good point, where if I want to build an income portfolio, I want it to be diversified. I'm not just relying on one asset class, whether is it T-bills, whether is it real estate, but being able to generate my income from as diverse sources. So that even if one particular asset class may be impacted, I can still be generating my income from other asset classes. If I was to look at the last few years, while some of the REITs have actually been impacted by the higher interest rates, the Singapore banks have actually done exceptionally well. So we saw DBS, UOB, OCBC having record profits in 2024 because while the REITs actually are impacted by higher interest costs, the banks typically make a higher profit when the interest rates are going up. And that was the case over the past few years, which is why they've been able to generate more profit and pay out more dividends as a result.
But we recently saw the earnings announcement for, I think it was UOB as well as DBS came out recently for the Q1, right? The earnings kind of missed the estimates that analysts had. And I think even UOB came out and said that they will stop giving guidance on earnings. So, because we talked about Singapore stocks and Singapore banks, what do you think investors can actually expect going forward when it comes to the outlook for these bank stocks?
So banks in nature are cyclical. They're very exposed to the economic cycle. So I think that is something that we need to realize when we're investing in bank stocks. So while we are investing in bank stocks for dividends, their profit can actually be volatile depending on the economic environment. If the economic growth were to slow down, their ability to give out loans will actually slow down. They might not be able to generate as much fee income because consumers might not be spending as much on their credit cards. They might see an increase in their non-performing loans if the borrowers are not able to repay back their loans. So I think that is something that we need to realize when investing in the bank stocks. And the question then is whether the Singapore banks are resilient enough to be able to withstand some of these shocks. I think in the past we have seen through different economic crises, whether is it say COVID, global financial crisis, that the Singapore banks have actually been able to ride out some of this uncertainty because they have actually got strong balance sheets. The capital that they hold is actually very sufficient. So that might provide some comfort for investors who are looking at the Singapore banks. But notwithstanding that, you must have the capacity to take some of this short-term volatility. I think just looking at what happened to DBS share price after the trade tariffs were announced, it came down fairly sharply from above $45 per share to at one point about $36, $37. So that's close to a 20% decline. And I think for investors who feel that they might not be able to take such volatility, then we need to think about other income stocks that might be less volatile compared to, say, the Singapore banks.
Okay. Yeah, and looking beyond Singapore, I mean, often we also still get questions, right, about, exposure to the US market or even the China market. Yeah, I mean, people, or rather our audience tends to ask us, right, is it still worth considering?
Yeah, and especially because the recent earnings reports from all the tech companies, right, turned out to be better than most people were anticipating. Probably not for Apple, but for the other companies. So yeah, I mean, we do get questions, okay, the earnings are pretty good as well. Why not still invest in US?
I think going back to the point around diversification, it's always good to diversify, but again, that would depend on the individual investment objectives and risk appetite of the investor. Because if I'm thinking about the 20% fall in DBS share price and thinking that that is highly volatile, then what we have for the S&P 500 or the US tech stocks is going to be even more volatile, as we have seen in the past. So one of the measures that we commonly use is this term called the drawdown, which is how much these different asset classes can come down by in the event of a sharp correction. And typically we see that the S&P 500, the US tech stocks would have a larger drawdown compared to, say, the Singapore stocks. So I think that's why they would say high risk, high return, because to be able to generate the higher potential long-term return, you need to be able to take the higher risk. So if I am actually close to retirement and I need this money for my retirement planning over the next few years, because I know that I will no longer be able to generate the income to make up for this loss in my capital, then maybe it might not be that good an idea to still have such a big part of my portfolio in US stocks, because then I might not have much alternatives to be able to make up for the losses. So I think that's the point on the individual investment objectives and risk appetite. But on the other hand, I have a 50-year runway for someone who might have just have graduated. Then yes, it is definitely good to have a diversified portfolio. And in this case, diversification means not just across asset classes, but also across different geographies as well. So apart from Singapore, US, China, I think those are markets that investors commonly look at. Then the question is, what is the different amount of exposure that we want in each of these markets?
One thing I notice people talking about more often now is European stocks. Given that there's a sentiment of rotation out of the US and going into Europe, what do you think about that?
If I were to look at the performance of different markets in the past few years, Europe has definitely been one of the standout performers. I think there are a few reasons behind that. First and foremost, if I were to look at the developed markets globally, there are a few key ones, including US, Europe, and Japan. So if investors are actually switching out of US related assets because of uncertainty towards their policies, uncertainty around the long-term viability of the US dollar, then Europe would stand out as one of the alternatives. Then on itself, Europe has actually done a lot over the past few years to be able to overcome some of the limitations that they had in the past. So whether is it in terms of energy security, whether is it in terms of being able to drive up the domestic economy. I think after the Ukraine crisis, there's been more of an impetus to be doing that. So for example, we see Germany wanting to spend more on their defense, wanting to do more to build up their energy security. So all of it is driving renewed investor interest towards Europe once again as a way to be able to hedge the exposure from the US.
Would you consider Europe?
I haven't really thought about it.
Okay.
Yeah, given that we've shared so much about different asset classes, right? Actually, this is something that's been on my mind, right? And I'm also starting to think about, do I want to approach my own portfolio strategy differently in this current climate? I mean, are the both of you doing anything differently?
For me, yeah, I've slightly changed my strategy. So I was quite heavy in US stocks actually the last few years. I think everybody were. Like what Gerald said earlier, my timeline, my runway for retirement is a lot longer.
Yeah.
And I think since 2020 till now, the US market, at least 2020 till now, when I was able to invest in the US market, it was performing quite strongly, and I was quite concentrated there. But I think given the sentiment currently, the current macro environment, and this is what I'm doing personally for my portfolio, I'm starting to realize that, okay, my risk appetite might not be as high as what I thought it was. So I'm not like selling down or like offloading any of my current US holdings, but I'm just looking at, okay, for new investments that I'm going to put in, so like my investments going forward, can I consider other options instead? So like bond funds, REITs also is one of the things I'm considering, because I was not a fan of REITs before. It's not something that I looked at all, but it's something now I'm kind of folding into my strategy. And I think like similarly for me, like I haven't done anything differently, but now these things are like on my mind. Right. I remember a couple months ago I was asking Gerald separately, like, should I start thinking about investing in China? Right. And then now, of course, I'm starting to think about Europe as well. And bearing in mind also that, Donald Trump has just started his presidency, right? So we can expect some of this volatility to last for a while. So I'm thinking about, adjustments that I would make, but I haven't actually actively done anything. I think it can be quite challenging also for us, because we are retail investors, right? So we are really quite small fry, and our capital is probably not as much as maybe someone who is an institutional investor or a bank, right? So we may not be able to spread out as much across all the different asset classes. And I think that's where mutual funds or ETFs comes in, because it can help us do that diversification like automatically inbuilt, right? What
about yourself? Has your portfolio strategy shifted at all in the last few weeks?
So it hasn't changed, but I have spent more time thinking about two key questions, which is what we have shared with a lot of readers around what we should be doing in this environment. The first is to know what you're investing in. So before we even think about investing in China, we think about investing in bond funds, before we invest in REITs, it is important to know what are these different instruments, what are the risks involved. So don't blindly invest in some of this simply because we discuss Europe and then you then go and buy a Europe fund. Or simply because we shared about REITs and then we'll go and buy into a REIT. But I think it is important to then understand what are REITs, what are the investment thesis around investing in Europe, and I think that will provide you with more confidence towards putting your money into each of these different investment products. The second point is really then going back to why you invest, because we need to be able to answer this question to be able to then even think about whether I should be investing in, say, China, Europe, REITs, bond funds. Because the key question is there a particular goal that I'm saving up for? Does this actually fit within my lifestyle? So for example, if I find that I don't have enough time to research enough about China or Europe to gain confidence towards investing in them, then maybe I can still gain exposure by doing it through a global ETF.
Yeah.
Or I find that I don't have the ability to go and analyze individual REITs, look at what are the assets that they hold, whether they have enough balance sheet strength to be able to withstand the short-term uncertainty.
Yeah.
Then maybe it might be good to consider a REIT ETF as a way to still gain exposure towards this sector rather than having to choose individual REITs.
Yeah, in fact, I would say that, I think these days I'm thinking a lot more about, what are different ways that I can increase my income rather than how can I invest for higher returns. It's really about trying to find ways to safeguard against, not even knowing, like, is my job going to exist in the next 1 year? And what else can I do, skills that I can build, whether it's a side hustle or things like that.
Yeah, or having that option for passive income from your dividend stocks, your REITs and bond funds also.
Yeah.
I mean, if you have enough capital to get a very sizable passive income from that, I think it's fairly good option to consider. Yeah.
I think even if you do not have a large capital to start with, it is always worthwhile to start thinking about each of these different products. Because if we want to be learning, understanding about these different ways to invest, it's always best to start small.
Yeah.
Because you actually have got less in terms of the absolute amount of capital to lose. And I think that is when you realize whether that's something that's suited for you or not.
Yeah.
So for example, you realize that, okay, US stocks are maybe too high risk for your ability to withstand it. And I think it's only through putting your own money into it that you realize that it might not be something that's suited for me, or that maybe I thought this was something that was fairly safe, but then after I put my money into it, I realized that it actually came down by 10%, which was what happened to some investors who put their money into, say, selected bond funds. So I think that is effectively how I would look at it, in that even if I have a small amount of capital, I can actually start, because that's actually the best way for me to learn.
Yeah. I think that's a great point, because one of the ways I learn, there's only so much research I can do and so many websites I can go and read, go on Beansprout and read, this, read, that, read. But a lot of times the actual learning happens when I just open the account and put in, like, it doesn't have to be like $1,000, like just $100. I think just automatically, psychologically, your brain will already start being more active in noticing, like, oh, okay, the prices are moving, all these announcements are coming out. It's just those things, like, that saying is that if you buy a red car, then you see everybody else has a red car. It's kind of similar to that. Like, if you buy into Tesla or you buy into European stocks, then suddenly everything you see is about the European stocks. So naturally you process the information more because you are already invested in the asset class.
Yeah. I mean, I remember when I first started investing, a big part of the hurdle was just wondering, if I were to put my money in this, what's going to happen to it, right? And that first step was really just putting the few $100s into an ETF and then seeing that actually a few months later, the money is still there. Right? And then that gave me that sense of safety to start investing more. And I think, like what you said, going to read up more, find out more, and understanding how these movements happen as well.
Yeah, and a lot of my friends, when they ask me what platform to open to open an account with and to start investing, the first thing they always say is that when they open the account and go into a platform, it looks so intimidating.
Right. Yeah.
It's all in like dark mode, and it's like green and red lines, and then lots of numbers.
Yeah, and you don't really know what it means.
Yeah. But then once you start putting your money in, after that, numbers make sense, right?
Yeah, and especially because I think I was quite lucky in that I started investing at a time where markets were doing well. Yeah. So the numbers only ever went up.
Yeah, so all green lah for you.
Yeah, generally quite green, yes. Yeah. So on that note, I think for anyone who is looking to get started on their investing journey, I mean, do you have any advice for people like that?
I think, rounding up our discussion today, there are two key messages.
Yeah.
The first is that even though interest rates are coming down, for investors who are still keen to look for yields, there are various ways that we can still generate a good yield based on the different asset classes that we have discussed earlier. At Beansprout, we have shared a lot of these different options as well, as a way to be able to help investors find some of these products more easily. So do read up to understand more about these different options to be able to make a more informed decision. I think the second point is what we discussed around understanding why you are investing in it and what are the different investment products, that's probably the best way to be able to gain confidence in investing, whether is it something that's just meant to generating income or for capital gains in the long term.
I mean, the only thing I would add to that is really that the best way to learn is to get started.
Yeah.
And otherwise, the inertia will always be there.
Yeah. I mean, experience is your best teacher,
Yes.
honestly. So, yeah, if you don't start, then you won't ever know what is going to be good for you or what is not. Yeah.
Okay. So I think this is a nice place to end today's episode. So like we said, the podcast format is quite new for us, and we are going to be exploring different topics, different angles, and we would love to hear feedback from listeners, right? So do submit questions, suggestions for topics if you have any for future episodes. We've talked a lot about different asset classes, a lot of writing that we've done on this stuff. Visit the website 𝗲𝗵𝗲𝗃.com, to learn more about some of these things. And also remember to follow and subscribe and tune into this episode and share it with your friends.
Okay.
Yeah.
Thank you.
Thank you.